Video, I'm going to talk briefly about the basics of leasing and provide an example on how to make the leasing decision for your businesses. In a perfect capital market, whether you lease or borrow to buy should not make any difference, right? That is, the present value of lease payment, right? Payment plus the present value of the residual value of the equipment that you have leased should equals to the present value of loan payment, right? That is, the cost of leasing and then purchasing the asset is equivalent to the cost of borrowing to purchase the asset, and that is so true in the perfect capital market. However, we all know that the market is not perfect. Therefore, the decision to lease is often driven by real world market imperfections, especially related to leasing accounting, tax, and legal treatment. Therefore, we should know broadly how these lease can be divided into different groups. And there are two main types of lease. One is the operating lease. Under the operating lease agreement, the lessee reports the entire lease payment as an operating expense, and the lessee does not deduct depreciation expense in his income statement. The second kind of lease is capital or finance lease. Under finance lease, it is often viewed as an asset acquisition for accounting purpose. The asset acquired is listed on the balance sheet and the lessee incurs depreciation expense for the asset. The present value of the lease payment is reported in the balance sheet and the interest portion of lease payment is deducted as an interest expense in the income statement. As far as tax treatment of leasing is concerned, there are two main types. True tax lease. Under the true tax lease, the lessee can deduct the full amount of lease payment as an operating expense and the lessor receives the depreciation deduction associated with the ownership of the asset. The second type is non-tax lease. Under the non-tax lease, the lessee receives the depreciation deduction and can also deduct the interest portion of lease payment as an interest expense, while the interest portion of the lease payment is interest income for lessor. Now I want to talk about how you really make whether to lease or borrow to buy decision. And to make our discussion simpler, I have made these two cases. One is the true tax case, case 1, and case 2 is the non-tax lease. And we just covered what is true tax lease and what is non-true tax lease, right? So if you talk about this case 2, which is simpler, it's a non-tax lease. It's very similar to a traditional loan. Therefore, leasing would be attractive if it offers a better interest rate than would be available with a loan. But this is a simple case, so I am not going to talk in this video. However, the true tax lease is very practical and we deal every day. Therefore, I want to provide you an example. How do you make leasing or borrowing to buy decision in the true tax case? And to help in our process, I have divided the whole steps into 5 steps. Step 1, first you compute after tax of borrowing. Remember, all the debt you borrow to run your business, right, have some tax benefits. Therefore, when you want to make this kind of decision, you have to always consider after tax of borrowing, not before tax. Therefore, your first task is to find out what is the after tax cost of borrowing. Second, you need to compute free cash flow from leasing and what is the free cash flow from borrowing. That would be your second step. Third step, you compute the incremental cash flow. Remember, all these investment decisions are based on incremental cash flow, and in this case we have a two case, lease and borrow to buy. So we need to compute incremental cash flow, which is what is your cash flow from leasing minus cash flow from buying. And the next step would be step 4. You would use decision criteria such as NPV or IRR to make the decision using incremental cash flow. So you have to compute them. So when you make computations, finally you come to a decision phase and you make your decision using NPV or IRR of this incremental cash flow. Now next, I want to provide a numerical example on how to really do it. Here is an example. A company has decided to acquire the use of a machine costing $600,000. If purchased, the machine will be depreciated on a straight line basis to a residual value of 0. The machine's estimated life is 6 years and the company's tax rate is 21%. The company's alternative to purchasing the machine is to lease it for 6 years. A lessor has offered to lease the machine to the company for $140,000 annually, with the first payment to be made today, with 5 additional payments to be made at the start of each of the next 5 years. In this case now, should you lease or borrow to buy if you can borrow money at 12%? So in order to solve this problem, I have listed the useful information here. So that is, the cost of the asset is 600 and cost of borrowing is 12%. And if you decide to lease, the lease payment is going to be $140,000 per year. So you have to make the first payment today and next 5 additional payment at the start of each year for the next 5 years, right? But if you decide to borrow to buy, then you can depreciate that using a straight line method to a residual value for next 6 years, which would be, you would be depreciating $100,000 annually for the next 6 years, right? So the tax rate is 21% now, and the salvage value is 0. How do you make whether to lease or borrow to buy in this case? Remember our 5 steps. Step 1 is to compute after-tax cost of borrowing, right? And how do you compute after-tax cost of borrowing? Then you would simply do your cost of borrowing, right, times 1 minus your tax rate. So that gives you the after-tax cost of borrowing, and which is 9.48%. That's our step number 1. Now step number 2 is to compute free cash flow from leasing and free cash flow from borrow to buy decision. Now let's compute first what is free cash flow from leasing. So let's look at how much is the lease payment. Remember, the lease payment is cash outflow, and since this is a true tax lease and the lessee can deduct the full amount of lease payment as an operating expense, right? So there is some tax saving of that. So let's compute how much is the lease payment. And for our case, as we all know, that's a cash outflow, so negative of the lease payment. And I'm gonna fix that cell because I want to draw it to the next cells. So the lease payment is going to be at the beginning today and next 5 years, right? That is going to be your lease payment. What about income tax saving? Remember, this lease payment is an expense in your income statement. So there is some tax saving. So how much is the tax saving? So whatever lease you pay and 21%, you don't have to pay the tax, right? So it's going to be lease payment times the tax rate is going to be income tax saving. Again, I'm going to fix both of these guys because I want to drag it to other cells, and I'm going to put a $sign right here. So I put this $sign and then drag it to compute my tax saving for the next this year and next 5 years. So that is going to be my income tax saving. Now let's see how much is the cash flow from leasing then. And plus your tax saving is your inflow, and the net cash flow from leasing is 110,600 outflow for today and next 5 years. So that's how you compute the free cash flow from leasing. Now let's look at how we compute free cash flow from buying. So if you decide to buy, then you have to purchase the equipment at the beginning of the period, right? So therefore, negative 600,000 is going to be your cash outflow. So that's the cost of equipment. What about the depreciation? So the depreciation tax sale, actually, what is the depreciation tax sale? So remember, if you buy the equipment and you can depreciate over the next 6 years, and remember that depreciation is an expense in your income statement, and therefore there is some tax saving, and that's what we refer here as a depreciation tax sale. And how do you compute that? And that is going to be your annual depreciation, right? 100,000 times the tax rate. That is the saving in terms of tax saving you are having since you decided to buy the equipment. And I'm going to again put the dollar sign and then drag it to the other cells to compute the depreciation tax sale, and that is going to continue for the next 6 years, right? Okay, that is going to be the depreciation tax sale. Now what about the cash flow from buying? In this case, cash flow from buying is going to be your cash outflow, right, plus your cash inflow. So I'm going to write this, and in the current year it's going to be negative 600,000, and then if you drag it to the other year, so the cash flow is going to be positive 21,000 for the next 6 years. So this is our step number 2. We computed cash flow from leasing and we computed cash flow from buying. Now let's go to step 3. Step 3 is to compute incremental cash flow, right? And how do you do that? This is cash flow from leasing minus the cash flow from buying. So in this case, it's going to be cash flow from leasing minus cash flow from buying. So if we do this, we get the incremental cash flow, and you can drag it, and that gives you the total cash flow, incremental cash flow. And now once you compute incremental cash flow, now we are in step number 4. And remember, step number 4 is to compute the NPV or IRR for incremental cash flow. And I'm going to compute here NPV for incremental cash flow. It's going to be equals to NPV and the rate. Remember, what rate are you going to use? Are you going to use cost of borrowing or after tax cost of borrowing? Keep in mind, if you use the cost of borrowing, it's wrong. It is not true, because if you want to, lease also increases the financial burden. So there's some tax deduction on the interest payment. So it's not fair to use cost of borrowing. So you want to use after tax cost of borrowing. So that's going to be the rate and all the future cash flow, not the current. So you have to do the future incremental cash flow and plus the current cash flow. Why do we not include current cash flow in Excel's NPV? Because the way Excel computes NPV is always discount, and this year's cash flow does not need discounting, so therefore we add them at the end. So that gives us the NPV of differential cash flow, right? And how do you make the decision whether to buy or lease in this case? So if NPV is negative, then you buy it. If it is positive, you lease it. That's how you make a decision using NPV. Similarly, we can also use IRR function to compute or to make the decision. So how would you do this? You'd compute the IRR for incremental cash flow and you compare it with after-tax cost of borrowing. So let's compute IRR for incremental cash flow, which is IRR and then bracket, which is easy, right? All cash flow, including current year cash flow and future cash flow, right? So that gives you the IRR of differential cash flow, which is 11.65%. That means this is the internal rate of return for this incremental cash flow. Whereas the after-tax cost of borrowing is 9.48%. So what do? How do you make that decision? So if, remember here, if the IRR is less than after-tax cost of debt, then lease it. If it is more, then buy it, and hence our decision is to buy. So this is how we make the decision. This is a little bit technical. I hope it makes sense to you. Thank you.